Hi, this is Randy Fitting with Right Side of the Chart, and today is Thursday, March 28th, 2019. Wanted to do an overview of some of the things I'm watching right now. So we'll do this will be a subscriber-only video. We'll cover the broad markets quickly, then look at other sectors and commodities that stand out. I continue to start out with this chart. This is the bigger picture, weekly chart of the SPY. Showing that key resistance level, and you can see now we're starting to get a little bit of downside traction so far for the week. The candle's still green, meaning we're trading above where we closed last week, but just by a hair. There's the bottom of last week's candle. So again, the probably the most salient technical feature on this chart, or I should say development recently, was that false breakout. Intra-week we had cleared that resistance level by a large margin. There we go. We just ticked red. Again, it's a weekly chart. This candle will finalize tomorrow. But that would be a start to see a red candle this week, closing below last week's candle, particularly in the wake of that failed breakout there. That's where it has more significance than had we just, let's say, tested that level again and maybe only made a slight intra-week pop or not taken it out at all and then closed in this range. So that's bigger picture, and again, that'll be continued tomorrow up until 4 p.m. because that's really all that matters on a weekly candlestick, is the close at Friday at 4 o'clock when the markets close for the week. And zoom into the daily chart. You can see that big green candle post-Fed, followed by the big red candle, the fade. And yesterday, I believe it was, I added this level here. We'll call it around 277.50, and that defines the bottom of the recent trading ranges. So my expectation hasn't changed for weeks now that we'd fail at this level, and the fact that we're now after this failed breakout right here, the fact that we've had that failed breakout and then the impulsive red candle only helps to strengthen the case. Now again, we didn't move sharply lower, and that's usually what you see after a failed breakout, but not necessary. Again, the most important thing is how this range is resolved. One thing, if nothing else, this has just been a lot of noise here with what looked like the bears taking it after that initial. We tested on these. Again, these are daily candles, so it was over a week of trading and testing that level. Started to move down impulsively, shot back up, and then ended up taking it out. Now back down below. So we'll just call this Whipsaw City. So we need to exit Whipsaw City, find the exit, and that's either going to be, or I believe it'll be above that green candle for the bulls. Still not my preferred scenario, or break below that 277.50-ish level, especially a daily and or a weekly close. And this should seal the deal when we take out that candle, if we take it out from March 8th. So that's where we're at. Until then, we can try to squeeze water from a rock, blood from a stone, whatever you want to call it. Take it as you will. It's just a test. So you can't say the bears have won, the bulls have won yet. Again, it's just been a back and forth. I like to use the analogy of two heavyweight fighters slugging it out. One of those good fights that go, the distance, and, fighter A takes the first round, fighter B takes the next round. It goes back and forth, and then it goes down to a split decision. And so that's what we have here. So let's not even really talk on it much anymore. There's that negative divergence and a lot of other things that lead me to believe that we're going to break to the downside, and hopefully we'll know soon enough. Otherwise, we could continue to trade on there for a couple more weeks. Anything's possible. 60-minute chart. We had this most recent divergent high, which also came in the back test of that uptrend line there. That's this blue uptrend line. Comes off here. Really had a more of a price channel right there. That ended with a little divergent high there. Correction. Push back up. Back tested the channel from below. Started to roll over. It started to be impulsive after the FOMC pop on Thursday, with Friday's move down. But again, we hit this support level. I believe these are levels I had in the chart at advance, 277.67. Either way, it's a level now, and this is the next level down here, give or take. That line could be a little bit lower, 273-ish. So these are the near-term levels you need to watch. And again, try to, if you're not a very active trader, You don't want to read too much into this. It's just a lot of back and forth grind. But if you are an active trader and you're looking for the next objective short entry, it would be there on a break of the recent lows around 277.67. And of course, that's only one index. Even if you are trading the SPY or ES, in my opinion, you are doing a grave injustice if you're not also watching QQQ and as many other indexes. You don't have to watch a dozen of them, but what from my experience, if I'm trading, the Qs are my preferred trading proxy. If I'm trading an index, I like to trade NQ. And so therefore, for example, let's say on QQQ we have this little support level right here, the recent lows. Let's say I'm waiting for a break of that level because it's support. I won't short it unless SPY also breaks that comparable resistance level, because I've seen many times that one breaks down. Let's just say in this case SPY breaks first, takes out 277.67. You figure that's a sell signal, so you short, but then at the same time that happens, QQQ falls to that level and it actually holds, and the buyers step in. And because there's a lot of overlap with these two indexes, especially in the top components, if this one holds support and rallies, almost assuredly QQQ or SPY will follow, so that would prove to be a false breakout. So that's it. Again, you don't have to watch a dozen indexes. And in the small caps, they march to their own drumbeat. They're on the other end of the spectrum. You have the mid caps in between. So if you're trading large caps, you can watch QQQ SPY. You can watch DIA, which is a Dow 30, Dow Industrials. But again, that's only 30 stocks. I like to watch these two. Okay, so while we're here on the 60-minute chart, before I jump down to the 15-minute chart, most recently we had this sort of megaphone ascending broadening wedge pattern with a divergent high, pretty impulsive breakdown, broke below, back tested, and we've been moving lower. So again, we need to undercut those recent lows, and you can see all these lines below are potential support levels. We also have an official short trade on QQQ as of yesterday. We re-entered that one. Again, I will, I'm not happy with the failure rate on the QQQ short trades this year, but they've all been small, around 3% stop losses. And if things play out the way I think they will, this trade alone has enough potential to make up for, in percentage gains, all those losses and then some. Because if we head to where I think we may be heading this year, if my preferred scenario plays out, we're looking at a move that's going to be measured well over 20%, 25%, because if we get anywhere close, remember I color coded these, yellow is caution, orange and more severe caution, red time to get out of Dodge kind of thing, where if those break, whereas a lot of people maybe, most people don't think we're even going to see those lows. At least, in recent weeks, it seems to me the vast majority thinks that we're off to the races to new highs. So let's just assume that I'm right, and we're going to go back down. Again, I'm not looking for a test of the lows back in December. If we get anywhere close, if we take out my red line, in other words, I'm looking for an undercut of those lows by a pretty good margin. I think we'll just blow right past them. So therefore, again, that's a potential scenario. A lot of work to be done, let me just say that. And like any scenario, it may or may not pan out. But if we do head down there, and I've shared this before, I have to go back out to the weekly chart. Don't have it marked up here. Yeah, sorry, I have so many boards that aren't in order here. Let's look at SPY. Okay, here it is. On SPY, this kind of gives you an idea of where I think things will be headed in 2018 at some point. And that would look like a move down here to about 214. Get a reversal. That arrow might not be to scale there. I just expect a reaction. That would come back in and test that. We had a period of consolidation, a very significant period of consolidation back in 2015 to 2016. And that would also, a couple things would happen. As I mentioned, this PPO signal line, the white line, is currently back testing the zero line from above, which often acts as resistance when you're in a downtrend, and that trend line itself, the white line again, signals bullish and bearish trends. You had a bearish cross here, told you to get out of the market or short, and back then we bounced up, we back tested, there was your second objective short entry, and finally we took it out here and crossed back up and said the trend is now bullish, and it stayed that way all the way up to right here at this point in time, and has been bearish since. So that's back testing, and again, So if everything comes together, we're looking at something like this: a reversal on or around this level, come back down. It depends. It's hard to really predict how these indicators are going to look uh, down the road, because it depends on how we get there. If we do come on all the way down here to 214, or maybe we do test lows. By testing them, that means you're either going to come in reverse a hair shy, probably not right on it, and you rarely do that, or a hair below it. And so that would still give us this scenario of bullish divergence here. That would set the stage for a very nice, trend trade. We can position long and throw away the key, or at least tuck away the key for a little bit longer. We went long back here. We caught a good part of this rally, but admittedly not near as much of it as we should have. But in hindsight, I don't regret that. This was I don't know statistically if it's a Six Sigma event or whatever, as far as the bell curve there goes and the probabilities, but I can tell you it is extremely unusual and very far out there on the end of the bell curve as far as probabilities and statistics. So, we hit now the top of my trading range, my bounce target range, and that was from right here. I had this range. We go back in here. That was heading into the end of the year, where I said, I expected at minimum to come up here and at maximum up here. So, that was it. I milked a good part of the move on the bottom, which again had the sharpest gains came off that first leg up, and then momentum started to wane. And I just wanted to kind of, lay out the bigger picture for you guys, that this is, again, a potential scenario with a lot of work to be done. And that's how it would look if it plays out. So I'll be on watch if we started to get some, another impulsive leg down anywhere as we come close to these lows, to possibly all the way down here to that 214 area, to see if we have divergence setting up on this weekly chart, to see if it's on the daily chart, to see if we have any buy signals or indications that bottom is close at hand. And we'll do the same thing that I did back here: scale in long here and scale out of longs at the right time. Or again, if the charts are constructive enough, just set some stops and maybe just trail them up and let those positions run. But don't expect this again. This is a pretty unusual unidirectional rip. If you recall back at the end of last year, I expected us to get up as high as where we are now, but I thought it would look something more like this, and that's where I had exited and started to try to game the first short pullback, and we never really got that. But that doesn't mean that we can't get that we can't still fail here at this point. Okay, back to the intraday charts. Probably spent more time on the broad markets than I should have, but I think that's important, because that's where the overall trend is. You don't want to swim against the tide. When you are in a sideways market, and I am going to go back and digress for a minute here, when you're chopping around like this, you can see disparity in the sectors within the S&P 500. You can see some going up and up in an uptrend, others in a downtrend, so you can swing trade long or short. But what happens is, and you can go back in time and compare these charts, when you get these sharp moves like this, almost all ships are lifted in a rising tide, and all ships go down in a falling tide, meaning all sectors. All 11 sectors fell here. All 11 sectors on balance rose there in the S&P 500. I know I'm looking at QQQ here, but SPY was similar. And so that's why it's important to keep an eye on the broad market. So again, lately it's not as important, because some sectors, like for example, financials have been falling, REITs and utilities, which I'll get to in a minute. I posted those today. They've been going up. So you can go long and or short and make money. But when you have these strong moves like this, almost everything gets dragged up or down with the broad market. So that's why, that's one reason it's important to always keep an eye on the broad market and try to identify when these big moves are coming. Alrighty, so back to that 15-minute chart. There it is, back test, breakdown back test. Need to take out the recent lows from the last few days there. I missed that top line, but you can see it there. And there's some supports along the way that may come into play. However, I do think, again, to me right now, more important than these little micro levels. I'm just giving you the levels that may, produce some, for active traders that you can either, go long, short off of, or micromanage a trade, maybe enter or add to a position. But I think if you're just a, not a very active trader, this to me right now is, I think, the most important level to watch is the two big candles from last week, Thursday and Friday, and it kind of jives with what I was saying before on SPY, but we undercut those, and we're starting to now move below there. And what I think will happen is once it becomes clear who won this battle, I think you'll see a lot of longs start to stop out and shorts become emboldened. So I think you'll start to accelerate the selling to the downside if that happens, and vice versa, or ditto to the upside, if they take out that big green candle. So on SPY, again, 277.53. If we go down through it, I don't think we'll continue to ratchet down slowly like this. I think it'll be more of a pretty quick move down to my minimum target here versus a stair stepping down. Okay, now being positioned short and bearish, I like this. I like what I'm seeing today. And if you recall in yesterday's video, I pointed out, I just jumped down, by the way, to a 15-minute chart. There it is. You can see, if you're not familiar with my charts up here, usually you'll see the time frame in the upper left-hand corner. So we were looking at a 60-minute chart a minute ago. That's the same divergent high and megaphone pattern there. The breakdown right here. The back test right there. But then what's set up on this shorter term 15-minute time frame, which I highlighted yesterday, was this bearish rising wedge pattern and this divergent low. So two things happened. We hit a pretty decent support zone yesterday while we had bullish divergence. And as I said, I wouldn't have been surprised to see us pop above it, and that's what we did so far, but we got rejected. And as I said, fewer things are more bearish than a failed breakout. Now, this breakout didn't really have a lot of traction. We didn't have a solid 60-minute close. In other words, even if I were to have been bullish and looking to position long on this, that's not the type of breakout I'd like to chase. I like to see, or take long, I should say. I like to see it impulsive. That means a big green candle. I like to see in volume expansion on the breakout. Let's see if we did have that. There's the breakout. No, you can see volume was not really very high. It's a lot higher on this drop. So what that is, it's a failed breakout so far. Popped above it a few times, and you can see we were pretty violently rejected off that uptrend line right there. So doesn't rule out this pattern. We have to keep an eye on that. It's still a potential falling wedge. As I said, I believe I said yesterday, we could certainly continue to work our way down in here because these divergences will just be extended. However, if this pattern fails to materialize, because this is clean, this is right out of the textbooks, bullish falling wedge on the 15-minute. If this thing doesn't play out, even for, that's the measured target up there. Again, this line, it depends on where we break out. If you break out at a lower level, the measured target goes down. It's just the widest part of the wedge. But if this fails to materialize, it shows you the nature of this market, and that is bullish chart patterns tend to have a much higher failure rate. Either they don't play out at all, meaning the wedge doesn't break out, or it breaks out but it doesn't meet its measured target, it falls well shy. And that is much more common when the trend is bearish, just as on the flip side, trying to short, rising wedges and head and shoulders patterns and megaphone patterns, all types of short patterns or bearish patterns, they don't work as well and when the primary uptrend is bullish. So this will maybe give us some insights here if this pattern falls apart, whether we get another breakout with a reversal or not. Once the divergences are taken out, which would mean that we come on down here, undercut these previous reaction lows, you no longer have divergence, and especially if the support zone here is taken out, then that would be just one big old fat check mark for the bears. Until then, guys, it's more of the same. That's what I'm looking for, but there's a big trading range here that still hasn't been resolved, and at this point it's anybody's game. Okay, and from this morning's post, sectors that I'm watching this week, Real estate, the REITs, IYR. IYR has been around longer than the one that's in the S&P 500, the XLRE. This is my preferred trading proxy if I'm trading the REITs. This is also the same sector that SRS tracks, and I believe DRN and DRV. Those are the 3-time leveraged ones. Be careful with those 3-time leverage ETFs. If you guys aren't familiar with that and you're new to trading, go to the FAQ page. It's now located under resources on the top menu, and the FAQ section. There's an ETF subsection, and I've written about the effects on leveraged on those, especially the 3-time leverage. You can also have it on 2-time leverage ETFs, and it's called decay. And basically, here's when you want to be long or short. Those 3-time ETFs are unidirectional rips and dips. These periods right here, you do great. In fact, you do better in this instance here. You'll usually do better than 3 times what the index does if you're in the short 3-time short ETF. But here, even though the trend was up, you get grind to pieces. This is when the decay happens. And again, I don't want to digress too much. I write about it and explain how the math works. It's simple. It's really just simple math, and that's all on the FAQ page under, I forget the title of that question. But all right, back to this chart. Wash, rinse, repeat. Divergent high, big drop there. Divergent high, big drop. And your sell signals come on trend line break if nothing else. Here was a trend line break. We didn't have a divergent high, but we had an uptrend line. We have a divergent high. Here's a trend line. I'm going to say this. I'm not crazy about that trend line because it doesn't have a lot of reactions. And the one here was too steep and prices kept going up. So what we'll probably need to see here to get a sell signal is some type of bearish reversal pattern, candlestick reversal pattern, maybe a 2, possibly a 3-day pattern. So I'm on lookout for that. But again, you have, just as you did back in those other times, you have negative divergence on both the PPO and RSI. And at minimum, because when I look at this chart, what it appears to me is the REITs had a breakout here. We had a triple top high, 1, 2, 3, and we broke out, back tested it. So at this point, my minimum target would be a pullback to back test that. And that could be bullish if that holds. I'll say that right now. We come in and back test or near back test and that level holds, bullish. Otherwise, we could get a failed breakout and come on down here. So either way, let's just try to put it in perspective or quantify it for you. That's about a 4% pullback from current levels. Not very much, but if you go with SRS, you can juice that up. But remember, if you're trading inverse ETFs, you're increasing your leverage factor. It's no different from buying twice as much, or you can short. You could buy 50,000 SRS, or you could short 100,000 IYR. It's the same net effect. If it goes against you, your losses are going to be comparable anyways in percentage terms. So just keep that in mind, just with your position sizes. That 50,000 of SRS is not the same as 50,000 of IYR, especially if you're using those 3-time ETFs as well. XLU. They've already rolled over, and we already have a sell signal. We had, you can see here, wash, rinse, repeat, very clear, unmistakable. Divergent high, correction, divergent high, correction, divergent high, correction. No divergent high, but a trend line break and a back test, correction. It's not labeled here. I don't know why. There's your divergence points right here. I'd have to draw that trend line like that. Divergent high correction, divergent high correction, divergent high correction. All right, you guys get the point. Double top and a breakout, but again, based on where we are in the economic cycle and everything else, I don't think this breakout holds. Yes, utilities are defensive issue stocks, meaning they I'm in Florida. Florida Power and Light, FP&L is our big utility company here. You go into a recession, the last thing you're going to do is stop paying your power bill. Might cut back on Netflix or something else like that, or might not upgrade to the latest iPhone when it comes out, but you're going to keep your power bill going. So therefore, they're recession-proof stocks. However, trust me, and you can go back, I'm not going to digress too long in this video, go back to any point in time, look at bear markets, they fall just as in line with stocks. So, and somebody even asked about that today. So while they are defensive issue stocks, they trade to their own technicals, and they can very much, and did. Here's an example, and I mentioned that. Here was the meltdown in the stock market right into the December 24th lows. Utilities went hand in hand. Why? forced selling. Everything I talked about before it even happened back then, hedge funds were too chock full of equities, individuals were, and the good gets thrown out, baby gets thrown out with the bathwater and corrections. And so here's a good example. You didn't see utilities rallying when tech stocks and everything else and growth stocks were getting killed. You saw them fall right in line, and the day they bottomed, the market bottomed, so did the utilities. However, the utilities have been a lot stronger. They broke out to new highs. The stock market, every single index has not. So these are overbought. There's a lot on this chart that tells me you're not going to get rich shorting or going long utilities. You have to leverage up a little bit because they tend to move less in percentage terms in the broad market because of their relative safety. But there it is. Wash, rinse, repeat. Divergent highs. We already went over that. Divergent highs and corrections. And in this case, our sell signal came here recently. We had a breakdown. We back tested. Remember, I just showed you on IYR the breakout in the back test. That was a breakout right there. We back tested so far successfully, but what happened is then we pushed up. We didn't even have negative divergence at that point, but we did on the back test here. We shot back up, back tested the trend line from below, and at that point put in our negative divergence. And so that tells me that this breakout is likely to fail, and that would be my minimum target right here, this target zone. So there's another thing. And SDP is the 2-time leverage short, and again, it's utilities, so you're not going to get clobbered. You have to use stops with anything. Trends can be pretty powerful, but this chart looks to me like well, again, it's more important to chart the one-time unleveraged ETFs, but you can see a little trend line there. And SDP, I'd have to give targets on that. I'd have to study the chart a little further. All right, and a few more things. XLK, remember this chart will almost mirror QQQ. Same story as QQQ and SPY as far as what I'm watching. We had those two big back and forth candles last week, and we're pretty much right around the bottom of the range. We're not below it by a safe margin. We've had a few intraday drops, but you can see that tech has rallied back up to close right around. We're really it's pretty much a breakdown and close right on the bottom of those candles, but we're hanging in there. So if you want to know what I think happens, but if it starts to happen, then you have a higher probability of it playing out. I think we'll fail here. We've already broken down and remain below there. Again, this just was a lot of bearish stuff that happened here. Divergent high, back test of the trend line, everything else, extreme overbought conditions. And that's, again, why I added the QQQ short on yesterday, because I think when it finally becomes apparent to all market participants that we failed here, I think the rush to the exits, at least initial, will be a pretty quick one. And that's why I wanted to get in front of that one. Even if it runs a higher risk of being stopped out, because I don't want to wake up to a 2-3% gap down or a sharp move in the tech sector or QQQ and then have to try to chase a short entry. Again, that's my trading style. I call it anticipatory. I'll try to anticipate breakdowns. Sometimes I'll go long a stock before it bottoms or before it breaks out of a bullish chart pattern if I have a pretty good degree of confidence. And I also think that it's all about risk reward and a lot of other factors there. So that's the story on XLK, which again is highly correlated with QQQ, and that's why I'm talking about that one. Biggest sector in both the S&P 500 and the NASDAQ 100. Other things to mention, TLT, as far as that IYR, the REIT trade goes, and the utilities, they are interest rate sensitive. So remember, bonds, prices, and rates work inversely. So this rally here in Treasury bonds that we've had recently, and this is TLT, the 30-year bond ETF, means that rates have been falling. And that is bullish for utilities and REITs because they're high yielding, they pay above average dividends, and so they're often considered, especially REITs, are considered bond proxies. And so where I'm going with that is, while I've been clearly bullish on TLT all year, especially since this breakout, the upside from this point is relatively limited. We're coming up on resistance here around 127.30. We still have that potential but unconfirmed divergence. I talked about it. Maybe it gets burned through. I still have more upside on my weekly chart before my final target is hit, about 128.56. But we could get something like this. I don't have a high degree of confidence. That's why we're not in this one as an official trade right now. But maybe we get a pullback. Maybe we even come all the way back in and back test here. That kind of doesn't mesh very well with my scenario for the stock market, because if the stock market starts to have that quick swoon down, if it breaks the support levels I was just covering earlier, it would be hard to imagine treasuries going down with it. Sometimes that happens, however. Usually they're inversely correlated, meaning one goes up, the other goes down, but there are times that they run a tight positive correlation, so we'll just have to kind of watch it and see how things go. And again, the point to that would be that whether treasuries correct now or later, and you don't have to have that tight correlation between treasuries and REITs, but I just wanted to say that that's giving me a little bit pause on shorting the REITs right now at this point in time, because treasuries are still in a pretty solid uptrend. Okay, I just hit the 30-minute mark, so I'm not going to go into the individual commodities. I was also going to cover couple other things I'll cover in another video. Another sector that I wanted to get to, but I'll just mention this one broadly. It's DBA, and I've highlighted it many times. This is a weekly chart. This is the agricultural ETF, so it has hit the pause button. Agricultural commodities, and here's a long-term chart, weekly chart. Wash, rinse, repeat. Look for these divergent lows. There's a trend line break, correction. Nice, clean, bullish falling wedge, confirmed with divergences like you like to see. So look for these divergent lows, falling wedge, breakout. It's been a lot of trades, although it's been in a bear market again, like anything else. And this is how I view the stock market going forward. Whether it continues to be in a bull or bear market, there's plenty of room to be made in swing trading these trends within a larger trend. And the beautiful thing about bear markets, and this is why I love bear markets, is that the bear market rallies are explosive, as they tend to be much more powerful than bull market rallies. The gains are come in quicker gains in short order, and this is DBA, and this is a well-diversified ETF, and just 22% gain in a few weeks there, a couple months I should say. Same story there. Here's another one. So I look at this chart, it just trades well to the technicals. I see these nice clean wedge patterns, breakouts, rallies, and this time around you have this wedge down here, and we've been building some very large divergences now for going on for a couple years, and the divergence is beginning to steepen. We have double divergence down here at the recent lows, and that plays into this chart, which we're back testing today. We've had a little pullback in DBA. There it is. So that's that wedge we just looked at on the weekly. I just jumped down to a daily chart. Here you can see what's in DBA right here. And I did the percentages recently. I updated those. Here, I'll put that up there for you. So there it is. It's back testing. Now it's cracking a little bit down below this trend line. Remember, it's an ETN, so it's not going to do a perfect job of trading the commodities. I'd like to look at them each on their own merits, their own technicals, I should say. And even then, yes, there's ETFs or ETNs for most of these, but I like to focus on the charts of the futures contracts, because the ETNs don't always do a perfect job. Some better than others, some pretty lousy on tracking the commodities. For example, I mentioned, what was it, sugar? No, well, I mentioned a lot. Yeah, sugar, we have an active trade on. Was it coffee or sugar? Coffee. That's close. That's getting close to the stop. Big bullish falling wedge there as well. But it was, cotton. That's the one I wanted to mention. Cotton, for example, and I mentioned this, put this one on as a setup recently. It just hit my first target, but it's pulling back, and that's what I figured yesterday. So maybe we'll get an entry here, but here's the thing. This, if you're going to trade cotton, you're going to buy the near month futures, and that's a symbol CT. This ETN takes the money and spreads it into 3 different baskets on long dated futures, so they don't have to roll as often, don't have contango. So you have futures going out, contracts I think almost a year out, at least 6 months out. And so that's how they do this. So therefore, you're going to notice from day to day, cotton futures might rip and be up 1-2%, and this thing's only up, 0.25%. And that's because, again, it's not tracking the near month or any one future contract. And longer term futures also tend not to be as volatile and move up as much because of the time priced into those. They're looking out for months from now. All right, I've got to wrap this thing up here. I'm going on and on, but said I wouldn't get into commodities, and here I am. All right, I'll do these update in another video or static charts. And at the end of the day, just remember this is what it's all about. I do a lot of focus on the broad markets. Sometimes I'm all over, a certain stock, sector, commodities, but it's all about asset allocation. This is just Google searched asset allocation pie chart. Now this isn't, I've just clicked on one randomly, but this is how my portfolio looks, and how, whether it's my long-term accounts, IRAs, even my trading accounts, I don't put all my eggs in one basket. And what that means is, if I'm going to trade NQ and I want to trade Apple, I'll realize that Apple is one of the largest components. There's a lot of overlap. And so what this should look like is, a certain percentage into commodities, a certain percentage into the equities, and even maybe long and short, or certain sectors. You might be short the broad markets over here, but you might be long REITs, for example, or this might be gold, treasury bonds. And what happens, and I've done videos on this, that over time, this asset allocation, study after study has shown this is a more important determinant of your overall portfolio returns than individual security selection. So I'm a big proponent of both strategic and tactical asset allocation. And the pie chart changes pretty rapidly, but I just want to point that out there, that by having those different things in there, you might be wrong on your call for a long on the broad markets or a short on the broad markets, but all of a sudden your commodity portfolio, your gold positions are doing very well and offsetting those losses. And that's, to me, one of the most important things in trading. All right, guys, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.